To everyone he meets.
Okay, you're back with GoldSeek.com radio for another Gold Nugget segment. Today's special guest, Peter Schiff from Euro Pacific Capital. Peter Schiff, CEO of Euro Pacific Precious Metals and author of several bestsellers, joins me for a market discussion today.
Thanks for having me on.
Let's kick off the discussion with the precious metals markets. You know, prices have been sluggish over the past month. The metals once again retested support early last week and ended with a near stalemate. Do you agree with the statement that we may have seen the lows, though, for the remainder of 2012?
Well, of course, we may not have. It just depends. Gold is down about $35 as we speak on the day. It's under a lot of pressure ever since the FOMC minutes were released about a minute ago. Apparently, the gold traders are upset that the Fed did not say QE3 is coming, next week. I read these minutes, and I don't see how they've closed the door on QE3. In fact, I think it's a certainty. You know, the Fed says that they're going to play it by year, and there will be more stimulus if the economy needs it. It's just that they're not saying it needs it now. Of course, they're keeping interest rates at zero, which is massive monetary stimulus already. The Fed has to print a lot of money and buy bonds to keep rates at zero. So I think we have QE3 already. But ultimately, if they are going to try to stop the long end from really rising, the Fed is going to be forced to rev up the printing presses even more and ultimately do more of this QE, which is just inflation, if it wants to prevent the whole recovery from imploding, which it will do without the QE3. So I'm as convinced as ever that it's coming, but apparently the gold traders want to hear those words in no uncertain terms, or they take an opportunity to take the market down. So gold is selling off. The dollar is rallying across the board. Bond prices are falling sharply as well, which, again, as bond prices keep falling, the Fed is going to be forced to print more money to reverse that momentum.
They have to continue with their policy of supporting the Treasury and the mortgage-backed securities, the toxic debt out there. Otherwise, this entire scheme of quantitative easing will implode, and the artificial economic recovery will simply disintegrate. Wanted to also take a look at the copper market. You know, it's been very strong relative to the precious metals, and commodities also were getting close to or are hopefully nearing a bottom. On the surface, this would seem supportive of higher gold and silver prices, particularly king copper. What do you think?
Copper hit a 52-week high today, maybe even a 2-year high. So copper has looked strong. And ultimately, there is a stronger tone to some of the commodities. Look at oil prices rising. So you are seeing pockets of strength, and I think those are more likely a harbinger of things to come. There is a lot of inflation that's been created, so a lot of price increases are in the pipeline. I think that people who are trading on today's FOMC minutes, trying to infer that the Fed is done with the stimulus, just don't understand how addicted the stimulus, this economy is, and how the whole thing will implode the minute the government, takes it away. So I would be fading into these moves, buying the dip in gold. Gold stocks, I still think the miners are incredibly cheap right now. I think at some point in time, people are going to be kicking themselves for not taking advantage of this opportunity to buy more of these stocks.
Gold stocks have provided somewhat mediocre returns as a whole over the past year. Last week, though, the XAU, at least on a technical basis, appears to have found some support. I think the smart money is picking through the shares and looking for discounted opportunities. Do you think gold and silver stocks may have seen their lows as well for 2012?
Well, Newmont Mining today, is making a new 52-week low on the day. That's the only gold stock in the S&P 500. So, other stocks are not on 52-week lows, but they're certainly in the vicinity of those lows. The market has been weak. It's hard to say that we've seen the lows. I don't think that the market's going to collapse. So I do believe that if we see lower lows, it's only going to be marginally lower. I think there's a lot less downside risk in these stocks than there is upside potential. So I wouldn't be so concerned about catching the exact bottom. It's a difficult thing to do, and you've got to buy these stocks and recognize that you might see them trade lower in the short run than your price, but you can't let that deter you if you are a believer in this bull market and understand inflation and what's going on with currencies. You just got to be willing to ride out the bumps. And right now, we're in one of those time periods where gold stocks are declining. I mean, look at the short-term trend, and it's down. I mean, the longer-term trend is clearly up, but the short-term trend is down. And so it's always hard to, anticipate exactly when that trend is going to reverse. But if you look at the long-term trend, the overwhelming momentum is positive. And so I think if you're going to stick with the longer-term trends, which makes sense, you can take comfort in that and be able to ride this trend and ride out the bumps.
I think it's sage advice. If we look back to the 2008, 2009 shakedown we saw in the precious metals as well as the stocks, equities, anybody who had followed your advice then would certainly be reaping the benefits today despite the sluggishness we're seeing temporarily. Trying to time your way in and out of these markets, you're not going to enjoy the full benefits of the bull market. Very few people can do it. I want to move on to the general equities markets. Wall Street finished up the best quarter in nearly 3 years last Friday. S&P 500 stock index closed the quarter with a gain of 12%. That's the market's best start in any year since '98. Thinking about going long U.S. equities, why or why not?
Well, I mean, we're not short U.S. equities. I have equity exposure for my clients, including U.S. equity exposure. I do believe that equity prices are headed higher because I believe that currencies are going to lose value. And so prices in terms of currencies are going to go up for just about everything. That would include equities. And if you look at the short-term trend in the U.S. stock market, it is still up. Over the last 10, 12 years, we've been going sideways, but the short-term trend is up, and I think that you need to stick with that trend. I think there is a shot that we could break this short-term upward trend and be in for some more significant downside in the Dow. I don't expect a collapse similar to 2008. I think the Fed would stand ready to interject its QE to do that. But that doesn't mean the Dow can't drop back down below 12,000 or even, maybe I think there's a trend line now at around 11,500. I mean, right now we're at 13,200. So there is some downside risk in the market, but I think there's a lot more downside risk in the bond market or in the dollar market. So if you're choosing between the U.S. financial assets, I think, stocks are probably your best bet over bonds or cash. Within the stock market, I think there are certainly stocks that will do better than others. So I think it makes sense to be selective and not just, be an indexer when it comes to being in the U.S. stock market.
Now, indexing's been dead, as you said, for 10 to 12 years. You can forget that. People talking about a strong dollar, you're really looking at a weak euro. The euro-dollar play is, 60% dominated by the movement in the euro currency.
You also have a weak yen policy in Japan right now. Everybody is weakening their currency. So, to say that the dollar is strong, but the dollar, I think, ultimately is going to win the race to the bottom when it comes to the major currencies as far as going lower. But that doesn't mean the dollar is always going to be losing ground against the euro or the yen. I just think over time it will continue to lose more value than those currencies. But you have to understand that all currencies are losing value, and you can see that in gold, although temporarily now we have been in a pullback in the price of gold, and gold has pulled back since hitting its record high back in September of 2011. It has been consolidating, it has been pulling back, but the long-term trend is intact, and we're headed higher. And I think, we're very close to the lows of that trend line. So I think it's going to be very difficult to push gold much lower than it is right now. I think it'll be even difficult to get gold down to even 1,500. I think it's much more likely that gold breaks to the upside and goes and sees new highs even before the end of the year.
Look at the longer-term weekly chart. Previous support in the neighborhood of 15 to 1525, but I agree with your sentiments. Anything below 1600 to me is just a buying opportunity du jour. Move the discussion here over to West Texas Intermediate crude. You touched on this. It remains a very hot market, and I think that could translate into soaring prices, obviously, at the gas pumps, with analysts now calling for $5 per gallon by as soon as this summer. Do you expect lofty energy prices to eventually put the brakes on this stock market rally?
Well, it depends on the government's reaction to those high prices. But I expect prices to keep rising because we're going to continue to create inflation, and so oil prices will rise. And I actually think gas prices in America will actually rise faster than the oil price because I think we're going to be exporting more and more of our